So welcome to all of the attendees to the Solifi and Tamarack webinar today. My name's Scott Nelson. I'm President CDO of Tamarack and here to facilitate a little bit. And so I will start by handing off to Dan for introductions to our esteemed panel of experts.
Thanks, Scott. Of course, this is Dan Nelson, founder and CEO of Tamarack. And been involved for in the California state legislation with the ELFA for a number of months here. Been involved in some of their webinars, and so really excited to offer this more of a kind of a how-to specific to some of the Solifi applications here. So looking forward to the presentation today, and hand it over to the next person to do an intro. Ray.
Yeah, so I'm Ray Wisbowski. I'm the CMO at Solifi, and as Dan has said, he's been involved with a lot of the ELFA, working around how this disclosure requirement impacts the industry. I've also been involved in a number of conversations and really internally, and Christy will introduce herself next, internally on how do we as a company, a technology provider, support our customers in meeting these requirements. So, Christy?
Christy Kozabowski, I am the Senior Director of Product Management. Good to see many names that I recognize on the call. I think most of you know me. I'm really here keeping an eye on the regulations, helping drive the roadmap, and making sure that the product meets your needs. So we'll be talking about some disclosures today.
We do call her our regulation guru, so.
Corey, could you take some time and introduce yourself, please?
Hi, my name is Corey Lawadji. I work for Tamarack as a senior consultant. I've worked in the equipment finance industry and Solifi products for over 25 years, and I'm currently working with Lusters on solution implementing the configuration changes needed for them to be in compliance with this regulation.
All right. Well, thank you, Corey, and thanks everybody for attending. So what we're going to do here is go to the next slide here, and really, I guess, Scott, do you want to take and kind of do an overview here for us?
Yeah, I'll just introduce. So these are the topics that we're going to cover. California Senate Bill 1235. Going to look at the originations workflow. Originations capitalized, the Solifi's originations product, also often known as Rapport, and you'll hear that back and forth. Looking at its current state and how it complies with these pending regulations. We're also going to, during the conversation, discuss various things that are being heard in the marketplace, and then we're going to end the session. The majority of the webinar will be answering questions from the audience. So we'll start to see those, and I'll be curating those to the panel. So Dan, I'll hand it back to you to start the the analysis of the regulations.
All right, thanks, Scott. So again, we're going to try and really go through this pretty quickly, and when I say go through this, it's going to be a review of the California Senate bill. That's the primarily what we're talking about today is really, this is the first state to come out with the disclosure requirements, and so we're going to touch on that, relatively high level. Who does this apply to? They describe in the bill, any financier, and again, any financier is persons that are providing commercial financing. That's how it's described. Is this just California? Well, yes, in 2022 it is, but for those that are also following along in the industry, New York and Utah have passed legislation, and many other states have legislation being discussed. It hasn't yet been passed, but it's active, and so we're seeing disclosures across the country. And if you'd like more information there, again, look to the associations like ELFA, NEFA, to help keep you informed. I mean, they're doing a really great job of staying on top of this and being advocates for us in this industry. So it is important. Today it's California coming up in December, but we fully anticipate other states are going to come across or come with legislation that is very similar to California. I do know from everybody I talk to that basically New York is just going to look at how things get implemented California, and they're going to learn from that and adjust their final implementation. So who does this apply to? And in California, it's commercial loans between 5,000 and 500,000 is the type of transactions that we're talking about. When do you need to comply? And it's December 9th. A lot of people think December 9th, it's 6 months starts of December 9th. No, the 6 months started, 5 months ago or 4.5 months ago. So this is coming up fast. And again, we're hoping, today's session will help you really get your arms around what you need to do and how you can bring originations into compliance by December 9th. So today, we're just going to talk about that, specifically Solifi originations, also formerly known as rapport, and get into more of the weeds. Now, so much of it you'll hear is, well, that depends, and bear with us because the system is highly configurable, and so it may require a deeper dive into your configurations. So, but we'll get into that in a little bit. What are we not talking about? This is your disclaimer here. None of us on this call are attorneys, and nothing we're talking about should be taken as legal advice or opinions. It's I guess you could say it's opinions, but definitely not legal advice on how to implement. Please refer to or go to your internal corporate legal counsel or however you get that advice for the actual implementation and your nuances of how you do business. We're also not going to be talking about other financing, line of credits, floor planning, factoring, other things like that. What we're focused on is the equipment finance side of it, where it's a sales type loan, basically a sales type lease. And then are there exemptions? And hopefully you're aware of this. Yes, there are exemptions. If you're a bank, you have an exemption if it's a true lease, often also known as an FMV. You'll have an exemption. Track leases are true leases, so there's been a lot of questions about our track leases exempt, and everything we're seeing is that does a track lease is exempt. And then there's the size of your business. If you're doing 5 deals or less a year, then you have an exemption. So when do you need to disclose? So there's been a lot of discussions around this as well. Some lessors will present multiple offers. They'll present 2 or 3 options. It may be a 36, 48, and 60-month deal, or there could be different options, and it's when you get to a specific offer. The language in the regulation is at the time a specific offer is presented. That's when you need to disclose to the customer, to the borrower. What do I need to disclose? High level, there are 8 data points or data fields that need to be disclosed. On this slide, these are just suggestions. When I say suggestions, these are kind of standard rapport InfoLease field names. You may recognize them if you're actively working in the system at that level. Now, again, these are just starting points to kind of give you an idea of the data points we're talking about. Again, when we get into some of the more workflow aspect of this, it may vary for you. So we'll talk about that a little bit as well. And so this is kind of an example, of how that form would look. It's up to you as the customer or the lessor to provide that form to your borrower. And this is just a very high level view of how that may look, how that form may look. So moving on. What we're going to do here is really focus today, as we said, on the originations rapport product. And what does that mean? In the life cycle of a transaction, this is very high level. I'm sure each of you will see that you may think there's missing steps, and we could break this out into much more detail. And yes, we could, but we want to just come up with a high level workflow. So you can kind of get a sense of what we're talking about, and where in that workflow does this regulation going to have an impact. So if we look ahead to as we go through this, you have entry, credit analysis, decision as we go through this, and we actually get through servicing and reporting. So that's kind of the workflow. It should be familiar to you. When we actually get into when does that specific offer presented, that's what you need to focus on. When in your workflow, when in your life cycle do you present that specific offer, and before you send out lease docs for signature. Some lessors, that may be at the actual credit analysis and before the decision is when they present the specific offer. And so it's at that point that you would need to follow the disclosure workflow, the disclosure process, where you generate and disclose, you send it to them and get signature before you can proceed. Others, it may be right after the credit decision and immediately before doc signature. So again, you need to look at how you have your system configured and your workflow to look at what point do you need to disclose the terms of the transaction to your borrower and receive a signed disclosure before you get into actually creating or submitting the lease docs for signature. So Ray, do you want to talk a little bit about the Solifi product suite?
Sure. So, one of the things that we wanted to make sure this audience is aware of, so Solifi has gone through, obviously we were IDS, have rebranded as Solifi, and it's part of that brand. We've also taken some of the names that you're most familiar with, InfoLease and Rapport, and have rebranded those products as originations and portfolio management, really being descriptive of what they do. So originations, obviously, Rapport is an originations engine. It's a highly configurable, workflow-based engine that allows you to go through each one of these steps. And we looked at that and said that it was, for the rest of this conversation, you're going to hear it referred to as originations. You might hear it referred to as Rapport as well, but. And then InfoLease obviously being the back office system that the origination books into, and then allows for the servicing of the lease and loan products. So want to just make sure that we had a level set on that as we talk about these things. We are talking about Rapport. We're talking, about using the terminology originations. So with that, I'm going to hand it over to Christy, who will get into a little bit of what originations is doing to provide you with support for this regulation.
Yep, thanks. So a couple of things. We did undertake reviewing the disclosures and kind of mapped it to what and how Solifi Solutions can support this new disclosure rule. A couple of things. One, originations already supports the ability to modify your workflow. So as Dan was talking about, it depends on where you're providing a specific offer. You're going to need to probably adjust your workflow to provide the ability to create a document that you can disclose to the customer to be signed. So that's already available to you today. You can go ahead and configure if you've got that skill set, or certainly with our professional services or Tamarack, helping you adjust that workflow. The second thing is then the ability of actually creating that document. So the California law is pretty prescriptive. It tells you exactly the data and the format, though we don't have a template. But the origination solution allows you to go ahead and create those documents and add them in your workflow as needed. So those are kind of out of the box and available to you already. Within originations, we do also have a standard APR calculation. So when we reviewed those are all out of the box and ready for you today. in reviewing those regulations, and certainly what we plan to validate with our customers, is some of the things we looked at was we're in review of validating that the originations APR calculation adheres to Reg Z. So per the regulation, we must adhere to Reg Z. So we're doing that analysis now. When you go through, and we'll talk about this in a little bit, but you need to disclose at origination, which is the primary area, but also if the APR significantly changes. I think Dan, 12.5 basis points throughout the life, you will need to disclose. And so ensuring that the portfolio management solution has something, we are looking at storing that original APR. So as originations is booking it, we will know that original APR. We are considering accepting that amount in a standard field and just storing it. The last thing that we're considering is within portfolio management, then adding a calculation for APR. So as you know, we've got our IRR and calcs. APR is slightly different. So we're going to be checking in with a working committee to see, should we be adding an APR calculation that as the contract is updating and getting modified, we're recalculating. So those are the 3 areas that we are considering right now. And that's going to be going into a working committee. So we have a working committee being formed right now that will be kicking off the week of the 24th. That working committee, I think many of you know, and I'll talk about it, but we're going to be talking about the things we're considering. Should we add them? Are they valuable? And then a couple of topics that we're always we're interested in. So where's everyone at in the implementation? And talking with a couple of the customers, something that hadn't really been obvious to me when I read the regulation was, if you're financing, you might need to do upfront tax upfront. And that's normally done later in the process. But if you have to disclose and include APR, that normally has to be done more upfront. So how is everyone thinking about that upfront tax? Is that something you're worried about? How do you plan to accommodate that? And then I think the whole restructure, right? I talked about if you have a material change, 12.5 basis points adjustment, you need to redisclose if the transaction, of course, is applicable. And so are you planning on creating that disclosure in the portfolio management? So those are the type of topics we're going to talk about in the working committee, along with the things that we are thinking about adding and really allowing that working committee to drive how Solifi solutions this. So if we go to the next slide, I think most of you should know about working committees. We've been doing them here at Solifi for the last several years. But a working committee is a group of highly interested customers in the topic that come together to spend time with Solifi, understanding the business needs. So this working committee is very focused. So we'll probably be spending 1 to 3 months together. We will come prepared with the things I'm outlining to you already. Here's the things we're thinking about. Here's the questions we have. How is your organization adopting? And it's just an interactive. So it's 8 to 10 highly interested customers coming together, helping us to decide how we're going to move forward. The benefits are you have direct feedback into the decisions we're making. We really look for 8 to 10 people that have read the regulations, understand them, and can come and share their information. And then as we develop the designs, as we deliver, if there's something applicable, you'll be pulled into that process, reading designs, coming into our sprint demos, seeing it as it unfolds, and then you'll have an opportunity for early site testing if you so choose. So this one's a little bit different for a working committee. It's pretty short, 1 to 3 months. We do these a lot. If your company is interested and you were not aware of this working committee, you can reach out to me directly and I'll get you added into it, and we'll be getting that scheduled in the next week or so on this particular topic. And with that, I think I'm turning it over to you, Scott, for question time.
Yep. We can go one last slide there, Dan, just so people in the audience we see we've added emails here so that you have the ability to contact our panelists as needed. And at this point, I sent out an invitation, I think starts the conversation for questions. So please use the Q&A feature for your questions. I've got a few here in front of me. The first one, Dan, I think goes to you and Christy. If I'm a lessor, do I provide these disclosures to the customer, or do my brokers have this responsibility if I'm working with brokers?
Thanks, Scott. I'll take first at that, and like many of these, it depends, right? The legislation calls it as a provider who is offering a specific offer of commercial financing, and it does say a commercial financing on behalf of a third party, which does cover brokers. So there's a lot of nuances there. So it actually calls, brokers may be included as providers depending upon the circumstances. So again, from a Tamarack perspective, this is where we would, suggest you go to legal counsel. For if you're a lessor working with brokers, you need to update your broker relationship docs to call that out. So it's not cut and dry in our opinion of what we've read here. Christy, do you have anything to add to that?
Yeah, that I agree completely. I will say I've been talking to a couple of lessors about this topic, and a couple of banks brought a good perspective that I had, again, not considered in reading the regulation, which is, while they are not really necessarily in this particular regulation, their brokers maybe, and more importantly, their brokers will be expecting this data be provided from their financing partners. So even though the technical bank may not be responsible for providing a disclosure, they may still need to provide all the same data to their broker so that their broker can be compliant. And if they don't, their broker may choose to go somewhere else. So that was just an interesting perspective. Both of the banks I talked to didn't have a perspective. They were still getting counsel advice and doing more research, but it was just a perspective I hadn't thought about. So I sort of was like, banks are off the hook, put them over there. And then it got a little bit more muddy when you think about relationships and maintaining those. So it's just interesting thought.
Okay, thank you. Dan, another one. What if at booking/commencement the transaction does not pass as a true lease? How does that affect the actions?
Yeah, there's been a lot of questions on that in the other conversations I've had where many deals are initially structured or presented as an FMV or true lease, but then as it goes through, it ends up where it really doesn't pass a FASB 13 or ASC 842, and so therefore the lessor could be exposed if they assumed it was a true lease, and then after commencement it fails to be identified and audited as a true lease. Then the lessor is exposed to those penalties, disclosure penalties by the state of California. And so it is something to be considered and think about how you're going to handle that in rapport. And some of the customers that we're working with, some of the lessors, they're actually just going to plan to disclose on every transaction, so they're covered across the board. So whether or not it passes or fails a true lease, they're still going to disclose the terms, just so they know they're in compliance one way or another.
Okay. Question from the audience that has a similar technical flavor, so I'm going to inject it here. Going back to your December 9th discussion, the question is this for new business as of 12/9 or existing contracts that fall into the dollar range? So I guess are things grandfathered into the regulation, or is it all about new starts?
I haven't heard that. That is not a question we've come across. Again, it'd just be my opinion that this would be for new transactions. But if you have if you're restructuring a deal, it's quite possible the state of California would view that as now you need to be compliant. I don't know if Ray or Christy or Corey, if you guys have heard anything there.
Yeah, well, so I think we have to go back to the spirit of what the regulation is trying to solve for, and that is that it's giving the borrower, the recipient, as it's mentioned in the regulation, the ability to understand the financial terms that go with the financial product, and for them to have the ability to shop for other options with other lessors before committing to a contract. So it doesn't, so that they're not presented with the financial offer, the specific offer, without first having the disclosure of what's in that offer. So that's the spirit of the law, is to give the recipient the ability to have more choice and more, really more upfront knowledge. So when I hear this question, they've already gone through that process where they've made a commitment to a financial product. They're already in the process of that financial product being serviced. So again, we're not attorneys. We're not giving legal opinion. The idea of disclosure would be that it comes before you're already in that relationship. But as Dan aptly pointed out, if you go through any sort of a process of reconfiguring that financial product, then the disclosure law, I would imagine, would kick in too. The one thing that would be a question mark is really if your annual percentage rate changes significantly, that's something that we would need to dig into to see if that does apply to products that are already in place.
Yeah, I think the legislation, just to close on that one, Ray, it actually calls out 1/8 of a percentage point. So that's where Christy was getting the 12.5 basis points. So, and that varies upon transaction. Like, I think if it's a floating rate transaction, it's actually 1/4%, not 1/8 of a percent. So it does vary based upon the type of transaction. So, again, you need to consult the legislation, the regulation. The information, the details we're giving like that are kind of high level in general for a sales type transaction that is level payments and fixed rate. So,
right.
Okay, Scott.
Well, Ray's warmed up, so I'm going to hit this. I'm going to go to him again. In Solifi's transaction lifecycle, Ray, when do people need to disclose?
Well, and Dan hit on this earlier in the slides of, it really comes at the point where that specific offer is ready to be presented to the recipient, to the borrower. So wherever that is in your life cycle, where do you insert that is really going to be contingent upon when are you going to present the specific offer to the recipient. And people will choose to do that differently based upon your business process flow. And so we're coming in to support your business process flow, but wherever you come to the point where you're providing a specific offer. Now there's some gray area here, and there's been lots of discussion about this particular point of, when you put, can you give them the disclosure at the same time you're giving them the actual financial product, the docs. And does there need to be space between there? And if you're using something like DocuSign, for example, to do electronic signature, can they be in the same envelope from DocuSign? And again, those are things that legal counsel will have to give you more specific advice on. What we can give you is just the high level of what you need to do is that the disclosure has to come first. And before they can see the actual the proposal that you have for them, the specific offer. So whether that can be in a DocuSign world, you don't show the actual offer until that first page is signed, and then it exposes the second offer. Is that enough time? Or in the spirit of law, do you have to do those separately so that the recipient or the borrower can go out and shop for other offers? Those are specific things that you'll have to answer for yourself as far as the time between those two. But it really comes down to the specific offer being placed in front of the recipient. The disclosure has to come first, and they can't see the specific offer until they've already reviewed the disclosures and signed that document. That's really the trigger point. So wherever you get to that place where you're going to put a specific offer in front of somebody, the disclosure has to come first, and they can't see the specific offer until the disclosure is agreed upon and signed.
Okay. Christy, anything you wanted to add there, or did Ray cover it pretty well?
I think, Ray, you covered on the originations piece of it. Just don't want to forget that after booking, if that APR materially changes, again, I think Dan referenced the 1/8 or 3/4. change that we will need to disclose within portfolio management as well, or during that life cycle. So it's kind of those two key areas per the regulation that you will need to adhere to.
Okay. We had a question come in that sounded like it fit here pretty well, because it's talking about kind of what happens, how many disclosures is the way I read it. But the question is, in the heavy equipment business, attachments are often expensive, and the question is, we're not clear on, do we list all items with a cost, or is a description with one cost? It sounds to me like kind of a question, are we doing multiple disclosures on a single, I guess it might be looked at as a single transaction. If I ask the question poorly here, I'll ask the participant to send it again, but I read it as, if I've got multiple things that hit the requirements triggers, do I have multiple disclosures, or do I have it all in one?
Well, I'll take that, and then maybe Corey or someone else, but it just, again, we're looking at the transaction. So if there's attachments, they may be additional assets under the schedule, but ultimately, the covered transactions are in that 5,000 to 500,000 range of what's being financed. So if all those attachments are a part of the lease agreement on part of that transaction, then they would be included. So I'm not sure, without more details or more information about the nature of the question or the structure of the deal, it's difficult to answer that. I don't know if Corey or anybody else heard more in that question than what I was able to address.
I'm happy to jump in with a question I had based on their question, which was, I agree, Dan. I think it's kind of based on kind of the transaction or the contract, if you will, that you're signing. But when I think about customers that are interim rent, so they're building their assets up, it's a contract, and I'm going to install them over 6 months. And in that 6 months, I'm doing interim interest. Do they try to disclose that interim? So because they can project that along with all of the assets that they project will take to install, because that's kind of an unknown at the time of signing, right?
So you're talking more of a progress payment type
Yeah,
structure?
yeah,
Okay.
exactly.
Yeah.
That's where my head went, at least. That's what I was thinking.
Okay. Corey, did you hear anything else there? Maybe you did. Have you encountered any nuances where assets are being, so I didn't make sense to me. So maybe we'll follow up.
Yeah, I concur with you guys are saying. Yeah, the transaction level is what I've heard. So
good.
Okay. Let's switch back to originations, the Solifi product, and the questions here. I'll group them. It's kind of, which versions of originations are we speaking of today? I mean, which versions are kind of covered here, and then how in the originations product, do we kind of solve these disclosure steps? And I think that goes maybe to Christy and Corey. I'll let you guys start.
Yep. I'll take the easy part, and then I'll kick it over to the expert on some of the how.
Okay.
So honestly, the rapport based systems should actually work depending on all of the versions we have, unless you're talking kind of way pre 6.5. The ability to modify your workflow and the ability to modify and add documents has been in the product base for as long as I can remember. So I don't think that there's a limitation. Now, with that said, we had talked about if the APR doesn't match Reg Z, and so we have to make a change there, and or if during the working committee they find something else that we think is beneficial for the product to be enhanced to enable you to be compliant, those new features would come out on a current release of originations. I don't know what we're doing yet, but just be aware that if we do in fact enable or add functionality, that would go to the current version of originations. And now I'll turn it over to the hard stuff to Corey.
Okay. Yeah, I mean, solving for this, again, we've kind of mentioned it's going to be specific for each lesser, primarily based on your legal assessment of the regulation, as well as your current workflow process. At a minimum, we see that you'll need to build and configure a new document to provide the needed disclosure. And, with an engagement with, Tamarack or Solifi, we can review your current business process and help you solution for this, as well as implement the configuration changes that are needed.
Okay. Did you have something to add, Dan?
No, I just
okay.
appreciate that. Yep.
Okay. Does origination support all the fields required to be displayed in the disclosure today?
So, Christy, you want to go first on that? And
Yeah. Yeah, absolutely. Yes, it does. All of the fields are available. Like I said, we are confirming APR matches Reg Z, but other than that, all those fields are available. Corey, maybe you want to expand on their specific configuration though, because that may not mean that they're all available in how they've configured.
Right, correct. Yep, all the fields are available, but they may not be in use with your current configuration, as well as they may not be, populated with data at the time that you need to provide the disclosures.
So it depends. You need to look at the configuration. Okay. All right. Scott, anything?
Okay.
What else do we have?
I'm reading this question that was put in before, and I have another interpretation of the last part of it, which a little more specific. It actually is saying, does every item have to be listed, or can it be combined into one cost? I don't know if that changes the way I asked the question, but it makes me think that because there's these different triggers, do you have to every item on the equipment? I don't know if that changes your answer, but I thought I'd say that again.
I haven't heard anything. I'll go first. I haven't heard or seen anything about, in detail listing all assets on the disclosure form. It's basically the amount financed. Now, they do the legislation or the regulation does allow for, if you're getting into payments that aren't level, that you can add a second page that really calls out those level payments. So there is some, there is the opportunity, if I can call it that, for add a second or third page on the disclosure for additional detail. But I've never heard, I haven't come across anything that says you need to list each asset. It's basically, they're looking to disclose the terms of the transaction. It doesn't necessarily need to be all 30 assets listed under the contract. It's just the total amount being financed. So I don't know if anybody else, Corey, if you've seen anything different than that.
Yeah, correct. No, that's what I've seen. I guess it's more the financed amount. So
okay. Another technical question. A company only finances term loans. If deals are greater than the 500K number, are they exempt from disclosure?
Yes. It's if it's a commercial finance term loan and it's greater than 500,000, that would be my interpretation of the regulation, that they do not need to disclose that. It's not a covered transaction in the state of California. In the state of New York, it would be. New York, I believe, it goes up to 2.5 million, I believe. Ray, is that what you remember? 2.5? Okay.
That's correct. So yeah, over time, these regulations will evolve, and there will be, as New York introduces something that's a little bit stricter than California, and we all know California likes to be, difficult to do business with at times. You're going to see a normalization of these amounts. That would be my anticipation, is looking back at history and when regulations are put into place, that one begins to trump the other, and so it will get to a place where, as Dan mentioned earlier, we do have some customers who just say, well, we're just going to disclose everything because this is a moving target, so might as well put this into our process flow now and take care of that. Again, that's a business decision for everybody on this call, what you want to do and how you want to deal with that. But certainly we're going to see an increased amount with New York. We know that for certain. And then it'll be, we'll see what cascades after that when they introduce that new amount.
Okay.
Good.
Another question that came in that I'm going to combine with another one I have on my board. There's a question about, where can I get an example disclosure form? Where can I get an example form? And then I'm going to combine that with, is it your expectation that amortization schedules are going to be required as part of the disclosure?
Yeah, that's been a common request. Many of us are familiar with things like UCC forms and all that. That was a standard. While California isn't providing any example forms, it's a 48-page document that describes what the 3 columns are and what goes in each of the 8 lines on those 3 columns. And you have to read through it. You have to grind through it because it all depends. What goes in each of those data points depends upon the type of transaction, because it varies based upon the transaction. So have I ever seen anything about providing? I haven't come across anything where the entire amortization schedule, P&I, principal and interest, has been called out. You need to provide that information in a high-level summary. But I haven't seen anything. I don't know if Christy, I thought I saw you shake your head. Have you seen anything there? So, okay.
No, definitely not.
So-
I mean, everybody I'm talking to is going to do kind of the law required and not much more, right? Because that's just more overhead.
And it's not specifically, the amortization schedule is not specifically called out in the legislation at all.
No. Mm-mm.
I mean, again, Dan, you hit it earlier in the presentation in the example that you put. So Dan's provided us an example in the slide earlier in the deck. But it really is those 8 fields. That's what the regulation calls for, and so they're at summary level to give the recipient the ability to quickly digest what they're financing. So it doesn't specifically say the word amortization or schedule within the legislation.
Okay, thank you. I'll let the audience know again, submit any other questions. I think I've run through all the ones that have been submitted. I have one that has occurred to me from reading some of these, which is maybe not totally expected, but since this is a regulation, maybe, Ray and the Solifi team going to comment on kind of how these records are, paper versus digital, and what you're seeing and feeling there, and how, how this might become a catalyst for people who are still moving in the digital direction, or anything. Any comments you have on that?
Yeah, I'll jump in. So, one of the things that we saw, pre-pandemic to pandemic, was a definitive move towards things like digital signature, the embracing of that versus wet signature. So there was some funny comments actually in the first year of the pandemic when people were forced to do this. I remember talking to one person who said, "I can't wait for this to be over so we can get back to wet signatures." It just made me chuckle, because we're never going back, and I don't think we are. But one of the things that we need to think about through this process is, as these regulations come online, one of the important aspects of I think a modern business is going to be automation. And so how do you automate processes? How do you get them through but keeping that the regulation, being able to adhere to the regulation through an automated process? And I mentioned DocuSign, there's eOriginal, there's digital signature providers that can be part of your process workflow, that can be triggered out of our Solifi Originations platform. So again, it comes down to your business process, where you're going to get to that specific offer, where you need to trigger that event, and where the data is coming from to populate that into a disclosure document. But there is the ability to do this in an automated fashion that still meets regulation, again, based upon making sure that the disclosure document comes before the specific offer. If you're not going down the path of a digital offering, then you do have to move that into a manual process. at a point, there's going to be up to a point where the system says you cannot go forward without first saying that you have this document presented, reviewed, and signed, and that will trigger then the next step. So automation obviously is going to be more efficient and can be better on the origination process. But there's it really comes down to your business decision on how you want to implement this regulation and whether you need it to be a manual process versus an automated process through some sort of e-signature platform. Christy, anything?
No, that's good.
Thanks.
If I just, Scott, before I go on,
Yeah.
to Ray's point is that, this is, it's California, New York, Utah, just all the more reasons to look at automation and bringing in and leveraging the originations platform to help you with compliance and removing those friction points in your transaction life cycle, right? That's take advantage of those integration points, those automations, those rules, all that to help you speed up the process. Again, all these states are putting in friction points, but a platform that is implemented in a well thought out way will help you combat and remove those friction points without having to increase your FTEs on just to get transactions through the system. So.
Okay.
Yeah, and that's part of the conversation today, right? The conversation today is how can we help you get to where you need to be? Tamarack and Solifi are both here providing, our thoughts on this, but it really comes down to your business process and how do we help support you? We have a very flexible tool that has the ability to be, a highly configurable tool, and with the right guidance can put those that automation workflow into place. One thing I will say about that is if you move into the direction of automation, from an audit perspective, there's the system itself is making sure that you're presenting the appropriate documents at the appropriate time. And so if somebody comes back to review the workflow, the disclosure document will always be a part of that workflow. And so that's part of the beauty of a system, as Dan just mentioned, is that you now have a foundation by which to automate that process and ensure that it's actually happening in the right order at the right time for your business.
Okay. Couple of questions come in. Dan, you triggered one when you mentioned New York and Utah. Do you have any insight into the dates yet in 2023 when those two states will trigger?
No, the last I checked at the ELFA site, they basically the governments or the ELFA, the Scott and the people there are it's a wait and see. They believe New York is just waiting to see how things go for California in December and beyond, and then they're going to adjust. That's my read. But again, hopefully, if you are members of one of the associations, please go to their government relation pages, and all three associations, AACFB, the three that we are active in, AACFB, NEFA, and ELFA, all are spending a lot of time on this, and so please tap into those resources as well.
Okay, Dan, I think Ray mentioned I guess it would be a draft disclosure form on one of the slides, and so there's a request that you put that back up and maybe comment to it if you want to predict its accuracy and usefulness or whatever else you want to say to it.
Well, yeah, this is the slide that Ray's referring to. This is really calling out the easy part are columns A and B, which you see on this form, the funding provided and the field. So columns A and B, if you think about this in an Excel document, are relatively straightforward as you go through the legislation or the regulation. What's over on the left here is an example of the verbiage that needs to be in column C, immediately to the right of the fields. And that's probably the most verbose part of the form that California is looking for. And that language, the text that shows up in that third column, varies greatly based upon the transaction. So it really needs to be, if you're, and Corey, I'd like to call on you if you have some lessons learned, because you're building this right now. And so, do you have anything to add on that?
Yeah, again, just to concur, yeah, right. The verbiage, there is significant verbiage changes based on, the transaction.
So yeah, it's, there's, that third column is going to be text, and you're going to need to pull in fields, merging in fields based upon the type of transaction. So, it's up to each lessor. Do I build one form that's highly dynamic based upon the transaction, the product, or do I do a disclosure for each product? It's really case by case. You're going to need to really look at the type of products or transactions you're offering, and then make a decision. Do I have a disclosure form, for a term loan versus a sales type lease versus, et cetera, et cetera. It's going to be case by case.
Okay. Another question just came in. I think you answered the first part of the question, which is if there's a change in pricing after origination and prior to booking funding. Maybe you didn't discuss that because you talked about it being in already recorded. Is a new disclosure required? So that's the first part of the question. So a change after origination prior to booking, and then there's a governance part to it. Would an acceptable notification to the customer follow the same criteria as the lease signer, i.e. could an IT manager be an acceptable for disclosure, but the CFO has to be the signatory? So that's a governance question that we haven't really touched on, but I think I'll turn that over to the panel, and whoever wants to take it will take it.
Well, unless someone else wants to jump first, I mean, it's the borrower, and so as far as the signature, are you talking, Scott? Was an IT person from the borrower or an IT person from the lessor perspective? I didn't catch that.
Yeah, it says, would an acceptable notification point at the customer follow the same criteria as lease signer?
Yeah.
So I believe they're asking about who has to sign it at the borrower organization. I think that's my read on it.
Yeah, it's going to be one of the principal guarantors at the borrower level. And then I think we've mentioned this. I think the tolerance, the regulation does call out tolerances, and the tolerance varies based upon the type of transaction. In the case of a sales type lease, it's 1/8% is what it calls out. And so that would be 12.5 basis points. So if you're doing a restructure post booking, where the APR increases, so if it's a decrease, you don't need to redisclose. But if it increases by more than 12.5%, then you need to get a new disclosure before you can go through with that restructure. In the case of a floating rate, it's 1/4%. So 25 basis points is on a floating rate. So again, sorry to point you to it, but you need to dig into the regulation and look at the type of transaction and what the tolerances are for that transaction, if it's a post-booking, a post-commencement change.
So
well, the actual question was that between providing the first disclosure before booking.
Yeah, that was I was just going to point out.
Yeah.
Thank you, Ray. Yeah.
Yeah, if the rate changes before actually, so I mean, my understanding of the regulation would be that you would have to redisclose because the disclosure has to be tied to the specific offer. Mm-hmm. So if the specific offer changes, it would trigger a redisclosure.
Yes.
Yeah. Okay. All right. I don't have any. I think I've got one last question that I think is best addressed by a closing from you, Ray. The question is in regards to the slide deck and its availability to participants. And per our I think we've had all the questions, and so I think I'll hand it to you, Ray, to kind of follow
Sure.
up and close and comment to the question. Will the slide deck and video be shared with all attendees so that they can share it with other members of their teams?
So that, yeah, of course, we'll provide that the slide deck post the session today. Just so on behalf of the panel, Tamarack, Solifi, I do want to thank you for spending some time with us today. We know your time is very valuable. We know that carving an hour out is not always easy to do, but we certainly appreciate your time. We do want you to know that we are available to specifically talk about your business and how your implementation of Solifi Originations, formerly known as Rapport, how it can support you in this implementation of the regulation. And we are available to do that. Our email addresses are here at the bottom of the screen. Please feel free to reach out to any one of us, and we'll be happy to follow up with you. Again, thank you for your time. The slides will be provided to you post us closing the session today. Give us maybe a day to get them out to you, but we will get those back out to you. Other than that, again, thank you for your time. I think that concludes our time together today.
All right. Thank you, everyone. Thanks, everyone, for joining.
Yeah, thank you.
Thanks.
All right.
All right. Thank you. Bye-bye.